guys, my name is Izal Melatulalia and my partner Vindi Saputra and Tiara Flavia. We would like to talk about analyzing operating activities. Keep on watching! So now we have 7 topics. There are income measurement, non-recurring items, revenue recognition, deferred charge, supplementary employee benefit, interest costs, and the last is income taxes.
The first topic is about income measurement. Income summarizes the financial effects of a business operating activities. It is arguably the most important metric of a company's financial performance. The main purpose of the income statement is to explain how income is determined, with its important components reported as separate line items. There are two alternative concepts of income: economic income and permanent income. Economic income measures the net change in shareholders' wealth during a period. Theoretically, it is equal to a period's cash flow plus change in present value of expected future cash flow. While permanent income is an estimate of the stable average income that a business is expected to earn over its lifetime, given the current state of its business. Permanent income is conceptually similar to sustainable earning power, and its determination is a major question in analysis. While economic income measures change in shareholder value, permanent income is proportional to value. Accounting income. Accounting income consists of 3 components. The first one is permanent component, transitory component, and value irrelevant component. Permanent component is the recurring component expected to persist indefinitely. Transitory component is non-recurring component not expected to persist. And the value irrelevant component is value irrelevant components have no economic content. They are accounting distortions. A major case in analysis is identifying the permanent or recurring component of reported income. Standard setters are aware of the need to separate recurring and non-recurring components of income. Accordingly, the line items of the income statement are arranged in a manner that allows an analyst to identify non-recurring components. There are 2 major components of accounting income, such as revenues or gains and expenses or losses. Revenues are earned inflows or prospective earned inflows of cash that arise from a company's ongoing business activities. These include cash inflows such as cash sales and prospective cash inflows such as credit sales. Gains are earned inflows or prospective earned inflows of cash arising from transactions and events unrelated to a company's ongoing business activities. Revenues are expected to persist indefinitely for a going concern. In contrast, gains are non-recurring. This distinction is important for analysis, especially when determining the recurring component of income. While expenses are incurred outflows, prospective outflows, or allocation of past outflows of cash that arise from a company's ongoing business operation. Losses are decreased in a company's net asset arising from peripheral or incidental operation of a company. Examples of losses are loss on sale of investment securities and an impairment of goodwill. Accounting for expenses and losses often involves assessing the amount of timing of their allocation to reporting periods. Timing is a matter of when they are incurred, often based on matching them with revenues generated. Many companies also report a measure of operating income. Operating income is a measure of a company's income from its normal operating activities. Operating income excludes all items that are either non-recurring or unrelated to the company's primary business activity. Typically, operating income excludes the following items from income from continuing operations. Number 1, gains and losses from a company's peripheral activities. Number 2, impairment losses from write-down of operating assets such as inventory, fixed asset, and goodwill. Number 3, unusual or infrequent items. Number 4, other revenues or expenses, such as interest income or interest expense and dividend income. There are three important aspects of operating income. The first one is pertains only to income generated from operations. Second one focuses on income from the company, not simply for the equity holders. The third pertains only to ongoing business activities. Non-operating income collectively refers to all components of income not included in operating income. Non-operating income includes all components of net income excluded from operating income. The next point is about non-recurring items. Non-recurring items consist of extraordinary items, discontinued segments, accounting changes, restructuring charges, and special items. Extraordinary items are distinguished by their unusual nature and by the infrequency of their occurrence. Unusual nature is an event or a transaction that has a high degree of abnormality and is unrelated to, incidentally related to the ordinary and typical activities of the company. Discontinued segments. Companies sometimes dispose of entire divisions or product lines. When these dispositions pertain to separately identifiable business components, they are called discontinued operations. Discontinued operations are separately reported on the income statement and the balance sheet. Discontinued operation, when they occur, can be substantial component of net income. The third is the accounting changes. Companies can change accounting methods and assumptions underlying financial statements for certain reasons. Sometimes, accounting methods are changed because of a new accounting standard. Other times, accounting methods and assumptions are changed to better reflect changing business activities or conditions. Also, managers sometimes change accounting methods or assumptions to window dress financial statement, particularly for managing earnings. The fourth is the restructuring charges. Restructuring charges are usually associated with major changes in a company's business and strategy. Restructuring usually entails extensive reorganization including divestment of business units, termination of contractual agreements, discontinuation of product lines, worker retrenchment, change in management, and writing off of assets often combined with new investment in plant, technology, and manpower. The fifth is the special items. Special items refer to transactions and events that are unusual or infrequent, both but not both. These items are typically reported as separate lines items on the income statement as part of income from continuing operations. Often, special items are non-routine items that do not meet the criteria of classification as extraordinary items. Special items constitute the most common and important class of non-recurring items. The next point is about revenue recognition. Revenues are defined in practice as inflows of other enhancement of assets of an entity or settlements of its liabilities resulting from a company's ongoing major or central operation. Gains, on the other hand, are increases in net assets or equity resulting from peripheral or incidental transactions of a company. Distinguishing between revenues and gains depends on the usual business activities of a company because our analysis treats these items differently. There are some criteria of revenue recognition. The first one, earning activities creating revenue are substantially complete and no significant effort is necessary to complete the transaction. Number two, risk of ownership in sales is effectively passed to the buyer. Number three, revenue and the associated expense are measured or estimated with reasonable accuracy. Number four, revenue recognized normally yields an increase in cash, receivables, or securities. Number five, revenue transaction is at arm's length with an independent parties. And number six, revenue transaction is not subject to revocation. The guidelines for revenue recognition. From our analysis perspective, inappropriate accrual recognition of revenues and gains can have one of two undesirable consequences. The first one, if a company records revenue prematurely or belatedly, then revenue is assigned to the wrong period. Number two, if a company records revenue prior to reasonable certainty of realization, then the revenue might be recorded in one period and later cancelled or reversed in another, overstated income in the first period and understates it in the later period. Analysis implication of revenue recognition. The income statement is important to the analysis and valuation of a company. This statement is also important to management for this same reason and others, including its role in accounting-based contractual agreements, management pressure to achieve income-based result, management compensation linked to income, and the value of stock options. Given management's incentive, we rationally expect managers to select and apply accounting principles that best meet their own interests but are still within acceptable accounting practice. The objectives of income reporting do not always align with management's incentives in this area. Our analysis must be alert to management propensities in this area and accounting discretion available.
Next topic is about deferred charges. Deferred charges are costs incurred that are deferred because they are expected to benefit future periods. The increasing complexities of business activities are expanding the number and types of deferred charges. Now, consider the categories of deferred costs. There are three categories. First, research and development. Second one is computer software costs. And the last one is costs in extractive industries. Next is about research and development. Companies undertake research, exploration, and development activities for many reasons. Some of these activities are directed at maintaining existing product, while others aim at developing new product and process. Research and development activities exclude routine or periodic alteration in ongoing operations, market research, and testing activities. Accounting for research and development expense is problematic. Reasons for these difficulties in research and development accounting are: first, high uncertainty of any potential benefits. And the second one, time period between research and development activities and determination of success. The next one is intangible nature of most research and development activities. The last one is difficulty in estimating future benefit periods. This characteristic of research and development activities cause difficulties in accounting for them. So, consequently, U.S. accounting requires expense research and development when incurred. And also, only cost of materials, equipment, and facilities with alternative future use are capitalized as tangible assets. Intangible purchase from other for research and development activities with alternative future use are capitalized. Computer software costs. Development of software for making purposes is an ongoing activity leading directly to current or future revenues. Under US GAAP, accounting for expenditures of computer software to be sold, leased, or otherwise market identifies a point referred to as technological feasibility, where these costs are capitalized and matched against future revenues. Next is about costs in extractive industries. Search and development costs for natural resources is important to extractive industries, including oil, gas, metals, coal, and non-metallic minerals. There are two basic accounting viewpoints.
The first viewpoint is full cost view, where all costs, productive and non-productive, incurred in the search for research are capitalized and amortized to income as researches are produced and sold. The second viewpoint is successful efforts, where all costs that do not result directly in discovery of researches have no future benefit and should be expensed as incurred. It's prescribed for oil and gas producing companies. Next topic is about supplementary employee benefits. Social pressure, competition, and scarcity of employee talent have led to a proliferation of employee benefits supplementary to salaries and wages. Some fringe benefits like vacation pay, bonus, profit sharing, and paid health or life insurance are identifiable with the period when earned or granted. These identifiable expenses do not pose problems of accounting recognition and accrual, but some supplementary benefits are not accorded full or timely recognition. It's like compensated absence and stock appreciation rights. The next topic about supplementary employee benefits are employee stock option. Employee stock option are popular form of incentive compensation. The reason why employee stock options are popular because first, enhance employee performance. Second one, align employee and company incentive. And then, viewed as means to riches. Next, tool to attract talented and enterprising workers. And also do not have direct cash flow effects. And the last one is do not require the recording of costs.
Now, we discuss about interest cost. Interest is a compensation for use of money. It is the excess cash paid or collected beyond the money borrowed or loaned. Interest is determined by several factors, and the one of the most important is interest rate. Interest rate is determined by risk characteristic of the borrower, and interest expense is determined by interest rate, principal, and time. Next is analyzing interest. Interest on convertible debt is controversial by ignoring the cost of conversion privilege. Diluted earning per share use number of shares usable in event of conversion of convertible debt. Analysis view interest as a period cost and non-capitalizable. Change in a company borrowed rate not explained by market trends reveal change in risk. Income tax. Temporary income tax difference. First is difference that are temporary in nature, expected to reverse in the future, mainly the nature of timing difference between tax and GAAP accounting and account for using deferred tax adjustment. Next is income tax accounting. Income tax accounting identify types and amount of temporary difference and the nature and amount of each type of operating loss and the tax credit carry forward. Measure total deferred tax liability for taxable temporary difference and compute total deferred tax assets for deductible, temporary difference and operating loss carry forward, and measure deferred tax asset for each type of tax credit carry forward, and reduce deferred tax assets by evaluation allowance. And the last of income tax accounting, first is financial statement adjustment, present following deferred tax asset and liabilities, forecasting future income and cash flows, analyzing permanent and temporary difference, and earning management and earning quality. Thank you for watching. Assalamualaikum warahmatullahi wabarakatuh.